era.
Today is Friday, April 10th, 2026, and we are decoding a market with a just a total split personality today.
Oh, absolutely. I mean, on one side, you have a consumer economy getting just absolutely crushed by resurfacing stagflation fears.
Right, and then on the other side, you've got this unstoppable AI hardware boom that, I mean, it seems to be printing infinite wealth in its own isolated bubble.
Yeah, it is kind of the defining feature of this current economic era. You are watching capital sprint in opposite directions at the exact same time.
Yeah.
And, it's driven by entirely different realities.
Exactly. So today's mission is to pull apart this wildly divergent trading session for you. We're going to look at today's market recap, the crucial carryover context from the prior session, and the underlying macro data that basically drove the chaos.
Lots of chaos to cover.
Definitely. But before we jump into the timeline, we just need to briefly and explicitly state that this deep dive is for market context and discussion only. It is not personal investment advice or a recommendation to buy or sell any assets. Always keep your own financial situation in mind.
Right, definitely.
With that out of the way, let's establish the baseline here. We're going to frame this as a question. Session 1, what set the stage before the U.S. session?
Right. So to understand the absolute whiplash you saw on your screens this morning, you really have to look at the setup from yesterday, Thursday, April 9. Because, yesterday, U.S. markets actually kind of found a floor.
Yeah, we had this brief collective sigh of relief.
Exactly. It was announced that Vice President J.D. Vance would be leading weekend negotiations in Islamabad, alongside Israeli Prime Minister Netanyahu authorizing direct talks with Lebanon.
So everyone goes home Thursday thinking, okay, the geopolitical off-ramp is finally under construction. The market priced in a cooling of tensions. But then, and this is where it gets crazy, the overnight twist hits.
Oh, yeah. A massive twist.
At exactly midnight Eastern Time, which is 7:30 a.m. Iran Standard Time on Friday, Iran's official Fars news agency completely changed the board. They threatened to outright boycott the upcoming U.S. peace talks in Islamabad until Israel halts its bombing campaign in Lebanon.
And the market reaction to that single headline was, well, it was violent. When automated trading algorithms parsed that threat, we saw an immediate spike in the equity risk premium.
Right.
Safe haven assets caught an aggressive bid, and spot Brent crude oil was just shoved violently upward, surging over $99 a barrel intraday.
Wow.
Yeah, those algorithms essentially modeled an immediate worst-case scenario, like a total resumption of hostilities and a prolonged blockade in the Strait of Hormuz.
But look, this is where you really have to look at the market through the lens of human game theory rather than purely mechanical data processing.
Oh, mean.
Well, the algorithms mispriced Thursday's peace talk headlines as a permanent structural fix. They ignored the fact that diplomacy is essentially high-stakes poker. I mean, an overnight boycott threat from Iran isn't a random, unpredictable shock like a hurricane.
Right, it's intentional.
Exactly. It is a calculated countermove.
Yeah.
It's leverage designed to extract concessions before anyone even sits down at the table in Islamabad. The algorithms just panic and blindly dump equities at the first sign of a scary headline because they simply cannot comprehend the developing logic of the political board.
I'll give you that. That is a critical limitation of the models. Algorithms completely lack the nuance for political board reading. I mean, they operate on binary triggers.
Yeah, totally. On or off.
Exactly. To a machine learning model, peace talks are either on or they're off. There's no mathematical variable for a bluff. So they price in the worst-case scenario of a permanent global energy supply chokehold immediately without waiting to see if it's just a negotiating tactic.
Right.
And that causes the overnight whiplashes you see in oil and equity futures. But, the geopolitical tension wasn't the only thing setting the stage for Friday's chaotic open. A massive global reflation wave was also hitting the wire overnight out of Asia.
Oh, the Asian inflation data. And honestly, this might have been the sleeper story of the night because it completely changes the global math.
It absolutely does. So on Thursday at 7:50 p.m. Eastern Time, which is 8:50 a.m. Friday, Standard Time Japan's Producer Price Index, or PPI, accelerated sharply to 2.6% year over year.
That's a huge jump.
It is. That is factory gate inflation, mostly driven by imported fuel costs. It heavily bolsters the case for the Bank of Japan to pursue further interest rate hikes. And then less than 2 hours later at 9:30 p.m. Eastern Time, so 9:30 a.m., Standard Time China's PPI turned positive, hitting plus 0.5%.
And to put that in perspective for you, that is the first time China's factory gate inflation has been positive since October 2022. For years, the U.S. has basically been relying on China to export deflation. Cheap goods coming out of Chinese factories have essentially masked the pain of our own domestic service inflation.
Yeah.
And that dynamic is now totally reversing.
And that emergence from industrial deflation in China signals that the recent global commodity and energy shocks are now actively passing through supply chains. I mean, by the time the raw materials are turned into finished goods and loaded onto cargo ships, the price tag is already rising.
Yeah.
That data fed directly into resurgent inflation fears hours before the U.S. markets even opened.
And as if all that pre-market anxiety wasn't enough, we had a major institutional curveball thrown at the Federal Reserve.
Oh, right.
Yeah. Late Thursday night, around 10 p.m. Eastern Time, the Senate Banking Committee indefinitely delayed the April 16 confirmation hearing for Fed Chair nominee Kevin Warsh.
The timing of that delay is incredibly problematic. I mean, incumbent Chair Jerome Powell's term expires on May 15th. The bond market relies on absolute certainty when it comes to central bank leadership.
Especially during a period of economic instability.
Exactly. This indefinite delay threatens an unprecedented leadership vacuum at the Fed right in the middle of a developing stagflationary shock.
Yeah, and look, bond markets hate bad news, but they absolutely despise uncertainty even more. It injected a serious institutional risk premium into Treasury yields overnight.
Definitely.
So just to recap the overarching narrative of our first session here. Overnight, global inflation data from Asia, a looming institutional void at the top of the Fed, and geopolitical game theory completely shattered Thursday's brief calm. Let's take a quick break, and then we'll get into the U.S. session.
Good.
All right, we are back. Let's move right into our next major question. Session 2. What moved markets during U.S. trading hours?
The defining moment of the U.S. session hit precisely at 8:30 a.m. Eastern Time, the release of the U.S. Consumer Price Index. And the data was nothing short of massive. March headline CPI surged 3.3% year over year. And underneath that, we saw a massive 0.9% month-over-month jump.
And the driving force behind that headline number is pretty clear. It primarily reflects the surging energy costs stemming directly from the ongoing Strait of Hormuz blockade.
Yeah.
That single geopolitical choke point is physically making everything in the U.S. more expensive to transport, manufacture, and sell.
Now, core CPI, which strips out those volatile food and energy components, was cooler at just 0.2% month over month. But, I mean, you cannot ignore the headline shock.
No, not at all.
It officially confirmed that the geopolitical energy squeeze is rapidly bleeding into everyday consumer prices. The sudden realization that we are entering a higher-for-longer monetary regime sent the 10-year Treasury yield spiking 6 basis points, bringing it to 4.34%.
Before we move off that 8:30 a.m. time slot, there is a localized data note worth mentioning. At the exact same time, Canada reported adding 14.1K jobs in March, keeping their unemployment rate incredibly steady at 6.7%.
That's a textbook stable print.
It really was. And it's a perfect example of an explicitly localized driver. It validated a stable economic trajectory for Canada and kept the Canadian dollar stable against the U.S. dollar, but it did not spill over into broader global risk assets.
Right, the global markets completely ignored it.
Yeah, because they were entirely fixated on the explosive U.S. CPI print. And if that inflation data wasn't painful enough, the 10 a.m. Eastern Time data drop felt like a genuine gut punch to the economy.
The preliminary University of Michigan Consumer Sentiment Index for April.
It was a catastrophic drop. I mean, the index crashed from 53.3 down to 47.6. But the crucial detail, the piece that really terrified trading desks, was that year-ahead inflation expectations spiked to 4.8%.
Wow.
Yeah. That paints a textbook stagflationary picture. Economic growth expectations are plummeting while the cost of living expectations are skyrocketing. Consumers are hitting their breaking point.
And, from a textbook macroeconomic perspective, this is where the underlying math gets brutal for equities. When you have a stubbornly high risk-free rate, like the 10-year Treasury testing 4.34%, it fundamentally alters discounted cash flow models.
Right.
Think of a stock's value as a promise of future payouts. When the risk-free rate, so the guaranteed return you can get from a government bond, goes up, investors demand a much steeper discount on those risky future stock payouts to make taking the risk worth their while.
Yeah, the math just changes.
Exactly. Mechanically, that higher discount rate forces a compression in equity valuation multiples across the entire market. The mathematical models literally demand that stock prices reprice downward.
But let's ground this in reality for a second. If you logged into your brokerage account at 10 to 1 a.m., you probably saw a sea of red. But this is where the disconnect between market price and intrinsic value becomes so important.
How so?
Well, the intrinsic fundamental economic value of America's 500 largest companies didn't actually evaporate in the 90 minutes between the 8.30 CPI print and the 10 a.m. sentiment data. Real-world business fundamentals move slowly. The fact that the S&P 500 slipped 0.11% and the Dow dropped 0.56% today is, frankly, algorithmic emotional pricing. It's not a reflection of instant corporate decay.
Oh, so you are looking at the illusion of instant information diffusion.
Exactly. The academic textbooks will tell you that all this new macro data is instantly and perfectly priced into the stock market the second the headline crosses the terminal. But retail and institutional participants are human beings.
Right.
They have bounded rationality. A portfolio manager doesn't just read a sentiment index and dump $1 billion of stock in 5 seconds. They have to convene risk committees, rerun earnings projections, debate the long-term impacts. It takes days, sometimes weeks, for the market to truly digest how this kind of stagflationary data actually impacts real corporate earnings.
You know, I will happily concede the limits of academic modeling here. True price discovery is always messy. The macroeconomic models are fantastic for qualitative sense-making. They tell you the direction the wind is blowing. But in the heat of a Friday morning sell-off, they aren't perfect, real-time predictors.
Yeah, the human element is huge.
Human-bounded rationality is very real. Long-term investors shouldn't panic sell into a temporary liquidity vacuum just because a consumer sentiment index flashed red on a Friday. The market needs time to digest the dual overhangs of sticky core inflation and deep geopolitical fragility.
So summarizing the narrative of our second session, the highly potent mix of a hot 8:30 a.m. CPI print and a crashing 10 a.m. consumer sentiment index drove a highly defensive, yield-spiking U.S. trading session. Let's take one more short break.
Right back.
All right, we are back for our final segment. Let's explicitly frame this next one, Session 3. Corporate events recap and what to watch next. Here is where the narrative completely fractures in the most fascinating way.
It really does.
If the broader market was so heavily defensive, right, if we are staring down the barrel of consumer stagflation, why did the NASDAQ composite actually close up 0.35% today?
Because we are witnessing a historic technological divergence. An absolute boom in AI hardware is aggressively colliding with a bust in traditional software. The global race to develop artificial general intelligence is no longer just a software competition. It has transformed into a monumental, capital-intensive battle for physical land, electricity, and massive computing infrastructure.
The $690 billion AI infrastructure sprint.
Precisely. And the market received tangible, undeniable proof of that structural tailwind this morning. At 8 a.m. Eastern Time, the specialized cloud provider CoreWeave announced a massive multi-year compute infrastructure agreement to deploy Anthropic's AI models at production scale.
And context is everything here. This announcement comes just one day after CoreWeave secured a $21 billion AI cloud deal with Meta Platforms on Thursday.
It proves beyond a shadow of a doubt that the foundational model developers, the absolute largest mega-cap tech companies in the world, are aggressively locking in their share of that infrastructure sprint. I mean, they are deploying capital into the physical world at a scale we haven't seen in generations.
It's massive.
CoreWeave surged 10% on the news, which effectively anchored the entire semiconductor and hardware space. That single subsector possessed enough gravitational pull to keep the entire NASDAQ in the green.
But the shadow of that massive hardware build-out is incredibly dark for the rest of the tech sector. I'm talking about the software bust.
Yeah, the other side of the coin.
At 6:30 a.m. Eastern Time, UBS downgraded the enterprise software giant ServiceNow from buy to neutral, and they slashed their price target dramatically, dropping it from $170 down to $100.
Ouch. That downgrade exposes a brutal reality about zero-sum corporate budgets. UBS explicitly cited mounting budget pressure on non-AI applications.
Right.
Imagine a chief information officer at a major corporation. Their overall IT budget isn't growing because the broader economy is slowing down. But the board of directors is demanding they deploy AI immediately. So where does the money for that raw AI infrastructure come from?
It has to come from somewhere.
Exactly. It gets aggressively drained from traditional software as a service products. The standard software tools are being left out to dry.
And the market impact of that realization was severe. ServiceNow plunged 7.5% today, and it acted like an anchor for the rest of the software sector. Snowflake dropped nearly 12%. It was an absolute bloodbath for traditional application software because investors suddenly realized those recurring revenue streams are vulnerable.
Yeah.
But software wasn't the only sector feeling idiosyncratic pain today. We also really need to talk about FICO. Fair Isaac Corp.
Oh, yes. At 9:30 a.m. Eastern Time, right as the opening bell rang, news broke that Senator Josh Hawley launched a formal anti-competitive pricing investigation into FICO regarding their dominant grip on mortgage credit scores.
And to understand why this is so damaging, you have to understand FICO's traditional moat. Historically, they have enjoyed near monopoly pricing power. If you want a mortgage in the U.S., a FICO score pull has essentially been a mandatory, inescapable toll bridge.
But that monopoly is fracturing. We are seeing alternative data providers like VantageScore actively undercutting FICO's pricing models.
Right.
This senatorial investigation signals that lawmakers are aggressively targeting that monopolistic pricing power. It introduces severe regulatory risk into a company that investors previously valued as an untouchable utility.
FICO plummeted roughly 13.5% to a 52-week low. Now, this was a massive, idiosyncratic, single-stock wipeout. It was largely contained within the financial software and data niche, meaning it didn't drag the whole S&P 500 down with it.
Right.
But it was a stark reminder of how quickly regulatory scrutiny can reprice a perceived monopoly. Which actually brings us to our closing bell joke for the day, straight from the trading desks.
Oh, I'm ready for this.
With headline inflation surging and consumer sentiment hitting record lows, the only things dropping faster than our purchasing power today were ServiceNow and FICO's stock prices.
Ouch. That is a brutally accurate summary of the morning.
I know. But cheer up and look on the bright side. At least the AI hardware sector is still booming, so maybe the robots will soon be smart enough to figure out how to fix this stagflationary mess. Step away from those red flashing trading terminals, forget about the Fed's leadership vacuum for a couple of days, and have a relaxing weekend.
Seriously, a little dark humor goes a long way on a Friday. But before we officially sign off, we do need to run through the critical items to watch over the next 24 hours and heading into the opening bell on Monday.
Absolutely. Number one on the radar. Watch closely for any weekend developments regarding the U.S.-Iran diplomatic negotiations taking place in Islamabad, led by J.D. Vance.
Number two, monitor for any escalations or potential ceasefires between Israel and Hezbollah in Lebanon. The entire geopolitical risk premium sitting in the oil markets right now is dependent on those two interconnected diplomatic fronts.
Number three, market anticipation is heavily building for J.P. Morgan Chase and broader bank earnings early next week. We need to see exactly how the financial sector's balance sheets are holding up under the pressure of these surging bond yields.
Very important. Number four, we will be listening incredibly closely to any Federal Reserve speakers reacting to today's energy-driven March CPI spike. Their tone and forward guidance will completely dictate the bond market's very next move.
And finally, number five, we urgently need updates on the Senate Banking Committee's timeline for Fed Chair nominee Kevin Warsh. The market simply cannot stomach the idea of an empty seat at the head of the central bank right now.
No, it cannot. It is a massive slate of catalysts looming over a single weekend.
It really is, and it perfectly encapsulates the strange environment we find ourselves in right now. We'll leave you with this final thought to mull over. Today showcased two entirely different, deeply disconnected realities. In one reality, stagflation is actively starving the everyday consumer, crushing economic sentiment, and breaking traditional corporate software budgets. In the completely alternate reality, the global economy is simultaneously funding the largest physical infrastructure build-out in human history for artificial intelligence. Are we entering an era where the only growth left in the market is strictly capital-intensive, silicon-based, and completely immune to the struggles of everyday consumer sentiment?
It is a profound structural tug-of-war, and we are likely just seeing the opening battles.
Let us know in the comments below if you think the AI boom can continue to defy gravity while the rest of the economy slows down.